Hello, my name is Frank Hughes and I'm a supervisory examiner in the Kansas City field office. During this presentation, we will be discussing the types of interest rate risk every financial institution faces. On this slide, we have listed these types of risk. Repricing risk is the risk from interest rate change timing differences on a bank's assets and liabilities. In general, all bank interest rate risk models address repricing risk. Increasingly, banks are moving toward models that also consider the other types of interest rate risk. Yield curve risk is the risk arising from changes in the shape of the yield curve as short and long-term rates move in different ways. Option risk is the risk that others determine the repricing of assets or liabilities. Options can alter the timing of cash flows. Basis risk is the risk that correlations between rates on assets and liabilities will move in a fashion which is adverse to an organization's earnings and value. It's the risk that different indices do not move together. We will talk about each one of these in more detail throughout the rest of this presentation. The first and probably most intuitive is repricing risk. As you can read on the slide, this is the risk from interest rate and cash flow timing differences. Let's illustrate this with an example. For simplicity, let's assume a bank has one asset and one liability. The asset is a 15-year mortgage priced on the 10-year Treasury rate and funded by a 1-year CD priced on the 1-year Treasury rate. Today, the bank is earning a 3% spread. Now, what happens in year 2 if market rates rise 2%? As you can see, the yield on the 15-year mortgage stays the same at 4%, but now the liability has repriced and the cost has increased from 1% to 3%, resulting in a decline in net interest income. The second type of interest rate risk we will discuss is yield curve risk. As we stated in the beginning of this presentation, yield curve risk is the risk arising from changes in the shape and slope of the yield curve as short and long-term rates move in different non-parallel ways. More succinctly, yield curve risk is the risk from changes in the shape of the yield curve. Let's look at an example. These next 3 slides show how the yield curve changed from 2004 to 2006. In 2004, banks were able to borrow short at rates close to 1% and lend or invest at 5% for longer-term loans and securities. Effectively, the banks in this scenario were able to take advantage of the spread and earn 4% by borrowing short at low rates and lending long at higher rates. What is the risk associated with this scenario? Let's look at how the yield curve changed over the next 2 years. As you can see here in 2005, short-term rates increased, while long-term rates for the most part also increased, but by a much smaller magnitude. As a result, the interest spread shrank and bank margins compressed. Let's look at what happened in 2006. In 2006, the yield curve flattened considerably as short-term rates increased, essentially eliminating the interest spread. And although not shown here, the 2007 yield curve actually inverted, further impacting the banking industry's profitability. Let's look at a simplistic balance sheet example to quantify the impact of changes to the shape of the yield curve. Here, the bank originates a 15-year mortgage that is priced off the 10-year Treasury and funds it with a liability that is priced off the 1-year Treasury. In period 1, net interest income is 5%. But what happens if the yield curve flattens? So here in period 2, the bank originates a new mortgage and earns 6.5%, but funds that with a liability that now costs 4%. As a result, net interest income has declined because of the flattening yield curve. Next, let's take a look at option risk. As we stated in the opening, option risk is a risk that others determine the repricing of a bank's assets or liabilities. Options can alter the timing of cash flows, and option risk is a risk that embedded and explicit options present to an organization. This can adversely affect earnings by reducing asset yields or increasing funding costs, and affect the value of a bank's assets and liabilities. Before we illustrate option risk and its potential impact on a bank's balance sheet and interest rate risk position, let's discuss typical balance sheet accounts that present option risk. On the asset side, mortgages and mortgage-backed securities can prepay or extend, while callable bonds can be called at the option of the issuer. On the liability side, non-maturity deposits can be withdrawn at any time, while even CDs can be withdrawn early despite prepayment penalties. In addition, some Federal Home Loan Bank borrowings can be called at the Federal Home Loan Bank's option. We're not going to cover them all in detail at this point, but it's worth noting that this list includes a significant portion of most community banks' assets and liabilities. Residential mortgages provide a good example of option risk. Unfortunately for banks, when rates fall, borrowers refinance, which is prepayment risk, and when rates rise, borrowers hold their mortgages longer than the banks would prefer, which is extension risk. That's option risk. Now, that does not make these bad investments or loans, but bankers need to be aware of this risk. Let's illustrate option risk in more detail by providing examples of the impact of prepayment and extension risk. Here we show a bank holding a 15-year fixed-rate mortgage. The bank has funded the 7% mortgage with a 3-year time deposit that costs 4%. In this example, the bank will earn 3%. However, what happens when general mortgage rates decline in period 2? Our mortgage customer refinances or prepays his mortgage and is now paying 5% versus 7% in period 1. Even if the bank is able to keep this customer, it is now earning a much lower yield on the asset while still paying the same rate for the time deposit. As a result, net interest income in period 2 has declined from 3% to 1%. Let's look at option risk in a little more detail in order to illustrate what happens to an asset in both a falling rate and rising rate environment. Here we have the expected average life of a typical pool of mortgage loans, assuming interest rates remain stable. Although the ultimate maturity of this pool of mortgages is 30 years, the average life is much shorter based on prepayments and consumer behavior. In this case, the average life is 4.5 years, and the bank can expect to receive most of the principal on this pool within the first 10 years. In this scenario, the bank will be reinvesting principal received at the current and stable market rate environment. But what happens if rates change? This slide illustrates what happens to prepayments and the average life if general market rates increase 100 basis points. In this case, the average life of the pool extends and prepayments slow down because consumers are not refinancing their mortgages as quickly as expected due to higher interest rates. As a result, the bank will receive principal payment at a slower pace than originally expected, and the below-market yield remains on the balance sheet for a longer period. This is called extension risk. What happens if general market rates increase by a greater magnitude? Here, the mortgage rates have increased by 300 basis points. As a result, prepayments slow down considerably. The bank will receive a much smaller amount of principal payments in the first 10 years compared to the previous 2 scenarios. The average life of the pool extends even further, and prepayments slow down considerably because consumers are not refinancing their mortgages as quickly due to higher interest rates. As in the 100 basis point increase scenario, but by a much larger amount, the bank will receive principal payments at a much slower pace than originally expected, and the below-market yield remains on the balance sheet for an even longer period. As we mentioned at the beginning of our presentation, basis risk is the risk that different indices do not move together, or the risk that correlations between rates upon which a bank's assets and liabilities are based will move in a manner which is detrimental to an organization's earnings and value. Let's look at an example. Here we have a 5-year loan priced off of the 3-month Treasury rate, funded by a 5-year Federal Home Loan Bank borrowing priced off the 3-month LIBOR rate. It appears this bank is well matched because both indices are based on identical repricing frequencies. But what happens if these rates change disproportionately? Here, LIBOR increased 2%, but the 3-month Treasury only increased 1%, resulting in a decline in net interest income, despite having a matched repricing frequency. That is basis risk, the risk that different indices with the same repricing frequencies do not move in unison. In this presentation, we discussed the types of interest rate risk every bank faces. We also provided examples to illustrate how these risks can impact a bank's net interest income. And as noted in the final bullet, it is imperative the bank management understand these risks and capture them in the interest rate risk management process.